Welcome back to Strongman Personal Finance. Ladies and gentlemen, we got a sponsored video today. And if you want a sponsored video, see the pinned comment below. Yes, you got to pay me money, but I'll make a video about whatever you want. I don't do stock price predictions and I don't do valuations. So in this sponsored video, we're going to talk about the difference between a sole proprietorship, a partnership, an S corporation, a C corporation, and it's not on here, or actually it is, but it's not separately stated, an LLC. So this is a person that, has a business, they're self-employed, they hung up their shingle, and they want to know how to, structure their business for tax purposes. The first thing that I want to say that is always confused, that makes me angry and upset, is that an LLC does not give you any tax advantages. You can deduct expenses from your business, ordinary and necessary expenses, without having an LLC. That's right. Do you know what a business is? It's something that you do in pursuing profit, where you don't get a W-2. That's basically it, okay? If I want to go out there and sell lemonade, that's a business. If I want to go on YouTube and scream at grifters and go, woo, that's a business. Why? Because I'm making money. That's right. I have revenue and expenses. It's a business. I don't need to form an LLC to deduct ordinary and necessary business expenses. So what's the purpose of an LLC? Well, it's filed with your state, and it exists to protect you from legal liability. Basically, you separate your personal assets from your business. Okay, so if you get sued, so if I'm on YouTube screaming at Jeremy LaFave and he sues me or whatever, he basically sues my LLC, and let's say I lose a lawsuit. Well, they can only come after, technically, the assets of my LLC, assuming you don't pierce the corporate veil, blah, blah, but that's a different conversation. But you form an LLC with the state to mitigate your legal liability, okay? You can be a sole proprietor and not have an LLC. You can just do a business. If you want to be more official, or if you want to maybe elect to be an S corporation or a C corporation, you got to form an LLC first, get an EIN, and then you can elect to be an S corporation or a C corporation. That's a step in the process. And honestly, once you have a business running and operating, it's probably good to have an LLC and to separate your personal assets from your business assets. So, an LLC, how is it taxed? Well, can you form an LLC as one person? Yes, you can. Single member LLC. Can you form an LLC with multiple members? Yes, you can. That's called a partnership, okay? An LLC, like I said, is simply there for legal liability. How does it work? Do I got to pay myself a salary, and do I got to track basis and this and that? Well, if you're a sole proprietor, no, you don't have to pay yourself a salary. You don't have to track basis, except, you do it for your assets and depreciation, et cetera, et cetera. But when you form an LLC, when you calculate your profit and loss, you do it on Schedule C of your Form 1040. That's your basic tax form. You have an LLC, you're legally protected, you run your business, you report it on Form 1040. Okay, it's basically on your regular tax return. If you take money out of the business, who cares? If you put money in the business, who cares? You don't have to track basis and all that. Okay, maybe some stupid states require you to do that. But in general, no. You don't need to track basis or any of that. It's just a regular business that you report on your normal individual tax form, specifically Schedule C. That's it. I've done it multiple times. I know. I have a business that I'm doing right now. Okay? Now, if you have a partnership, if you form an LLC, and you can have a partnership without an LLC. Me and my buddy can get together and form a business, work together, and guess what? We're a partnership. Boom. We're a partnership. We're working together. We don't have to have an LLC, but probably good if you do, okay? But, so, if you have a partnership, if you're working with somebody, well, you haven't elected any kind of special tax status. So, basically, the profit and loss flows through to the individual owners of the business, of the partners of the business, based on your partnership agreement. So, if you agree to split profits 50-50 in your partnership agreement, well, that gets calculated, your total profit gets calculated on Form 1065, partnership tax return. You get it gets allocated between the owners or the partners, and then each of the partners gets a Form K1 once the Form 1065 is filed, and that tells you your specific allocated profit and loss from the partnership. Okay, partnership, you're just working together with somebody. Sole proprietorship, you're by yourself, no LLC. Partnership, you're working with somebody else, no LLC. But both of them can be LLCs. It's just a legal shield, basically, is what it is, as long as you do it properly. When you get to S corporation and C corporation, that's where things get different. So let me use my business as an example. I don't make enough from my side business to form an S corporation. What is an S corporation? Well, it's a tax status. You elect to be taxed as a corporation. You can choose between S corporation or C corporation. That's right. You can become a C corporation by yourself. If you form an LLC, you're one guy or gal, because we're equal here, and you want to be taxed as a C corporation, you can elect with the IRS to be taxed as a C corporation, or you can elect to be taxed as an S corporation, okay? There's forms you file. Basically, there are certain deadlines you have to make, and if you're late, then you have to file. You have to explain why you're late and get an exception. But basically, you have your LLC, and you submit a form to the IRS saying, tax me like this, okay? For the S corporation, you file Form 2553, and for a C corporation, you file Form 8832. You're telling the IRS, tax me as either an S corporation or a C corporation, depending on what form. If you want to be an S corporation, you're what is known as a pass-through entity, and that's also what a partnership is. A pass-through entity is where all the profit and loss is calculated at the S corporation level, but the S corporation itself is not taxed except in very rare circumstances, which I've never seen in my many years of experience. I personally haven't seen it. But in general, the vast majority of cases, the S corporation doesn't pay any taxes. It's true. Corporations don't pay taxes, bro. S corporations don't. Because the profit and loss is calculated on the tax form, the Form 1120S, and then all the shareholders of the S corporation receive a Form K1. And the K1 allocates the pro rata profit and loss and what's called separately stated items. And then you report that profit and loss or separately stated items on your tax form, your individual tax return. It flows through. Any profits, any dividends, any interest, that all flows through directly to each individual owner of the S corporation. Now, if you're one person, you can become an S corporation. And at some point, once I grift well enough, I'm going to become an S corporation. Why? Well, there's certain tax advantages. If you are a sole owner of an S corporation, first of all, before we even get into that, there's more paperwork involved, okay? When you are owner of an S corporation, if somebody comes to me and says file my S corporation taxes versus file my individual taxes, you're going to pay a lot more for an S corporation, okay? Because there's many things you have to track. You have to file the Form 1120S, first of all. You got to track your basis, which is a whole nother topic. And I've got to calculate the profit and loss for your S corporation. Then I've got to, file the return, take the K1, and then finish your individual tax return. There's a lot more that goes into it. Also, if you take money out of your S corporation, so let's say you start the S corporation, you transfer whatever assets to it, or you title it in the S corporation's name, you put money into the business, and the business starts making all these profits, tons and tons and tons of profits. Well, you're like, hey, I want to take some money out of my S corporation. That could be a problem because you're required to pay yourself as an officer reasonable compensation. You're required to basically compensate yourself. So if you're the sole owner of an S corporation, you have all the shares, and you take money out of the business, that's a distribution, but you're also required to pay yourself reasonable compensation. So if you take, let's say, just as an example, let's say you take $50,000 out of your S corporation, and you say, oh, I'm not going to pay myself a salary, but you took money out of the corporation. The IRS can come around and say, hey, you didn't pay yourself reasonable compensation, but you took a distribution. We're going to reclassify that distribution as wages, and you're going to have to pay payroll taxes, et cetera, and potentially fines and penalties. If you're taking money out of an S corporation, you might want to heavily consider paying yourself for reasonable compensation because you, as the owner, you're basically an employee. You're an employee of the S corporation, and the S corporation has to pay you, even though you freaking own the thing. It has to pay you as the owner or somebody providing services to the corporation. So you're an employee of your own corporation. And when you're an employee, you pay what's called payroll taxes. Social Security and Medicare, the greatest programs to ever exist. Okay? When you pay those taxes, combined, it's like, so, the corporation pays half and you as the individual pay half. But basically combined, you as the owner and as the individual pay taxes. You have to pay the taxes. Now, it's a deduction on the S corporation's tax return, but it's income on your individual tax return. So if you pay yourself a salary, if you're the sole owner of an S corporation, and you pay yourself a salary of $50,000, and then let's say that's reasonable comp, it accurately reflects the value of the services you provided to the S corporation. It's a deduction on the S corporation, and then it's income. It's going to show up, that $50K is going to show up on your individual tax return as a W-2 from your own corporation. So you got to file W-2s, you got to remit payroll taxes, you got to file payroll tax returns. You got to do a bunch of stuff, okay? You got to run payroll. That's right. You got to sign up for a payroll provider and pay yourself. You got to deal with calculating how much work you did so you know what reasonable comp it is. Okay, there's a lot that goes into forming an S corporation. Now you may ask, what's the point? Okay, once you pay yourself a reasonable compensation, any additional profits distributions, in most circumstances, obviously you got to track basis too, but basically any additional profits are not subject to payroll taxes. When you're a sole proprietorship or an LLC, all of your bottom line profit is subject to payroll taxes, Social Security, and Medicare. With an S corporation, once you pay yourself reasonable compensation, any remaining profit, you don't pay payroll taxes on it. So it's a way to save on payroll taxes, but there's a lot of effort and work that goes into filing, maintaining, et cetera, an S corporation. So, let's say I make $30K in profit this year on my LLC, my single member LLC. Well, I don't want to spend all this time. I don't want to pay payroll taxes. I don't want to run payroll. I don't want to file my own Form 1120-S. I don't want to pay myself a freaking salary. It's a lot of work. But if I'm making $100K in profit and, I determine my reasonable compensation, the services to the corporation is $80K or $70K, well, I could save payroll taxes on that $30K remaining. So that's why the bigger the corporation gets, the more profits you're making, the better, the more intelligent it is to potentially consider electing with the IRS to be an S corporation. There's also state filing requirements. Now, I know I've done California tax returns for S corporations, and California actually taxes S corporations, from what I remember. So there's also additional taxes you got to pay with that. Okay, so it's a lot of work, but basically it's a way to potentially save on payroll taxes in the future. That's why you would elect as an S corporation. Now there's limitations to become one. You can only have a certain amount of shareholders. They have to be, I believe they have to be U.S. citizens or U.S. citizens or something like that. There's limitations to who can be an owner of an S corporation. Now C corporation is different. So it's not, remember, S corporation, profit and loss passes through. The corporation itself does not pay tax. But you're an officer. If you want to take money out of the business, you got to pay yourself a reasonable compensation. For a C corporation, it's different. C corporations think about all the publicly traded corporations. Apple, Meta, this, that. Those are all C corporations. They are taxed at the corporate level. So if a C corporation reports a profit, it's taxed at flat federal rate of 21% and whatever your state potentially charges. Okay, this is not a pass-through entity. So by forming a C corporation, you automatically pay a flat 21% on any profits that the corporation generates. And then if you want to get money out of the business, you got to pay a dividend. And dividends are also taxed. Okay, so it's subject to what's called double taxation. S corporation, only one person is taxed, the individual. You pay yourself reasonable comp, payroll taxes. The reasonable compensation is a W-2, and it gets put on your tax form. your individual tax form. With a C corporation, it's taxed at the corporate level. It doesn't just pass through. And then if you want to take money out of it, you can pay yourself a dividend. Or as an officer, you can pay yourself a wage, but that's subject to payroll taxes. Okay? So, I mean, I'm sure there's a reason for anybody to, I'm sure there's reasons to form C corporations. I've really personally only seen like one or two. I've mostly seen like S corporations or LLCs for like smaller businesses. C corporation is subject to double taxation. And, in most circumstances, if you're just a smaller guy, you're by yourself, maybe a couple people that own the business, it may not necessarily be the best way to do it. So that's kind of the differences there. So to review, when you first start a business, you just want to start a business. You start selling lemonade. You're sole proprietorship. You're just a person by themselves running a business. You can deduct ordinary necessary business expenses, and you get taxed on your profit and loss, and you report your profit and loss on your Schedule C of the Form 1040. If you want legal separation between your business and you and your personal assets, you can form an LLC, a limited liability company. You file it with your state, and that separates you and your business. You can do that as an individual, or you can do that as a partnership. A partnership is when two people get together and start a business. That's a partnership. Me and Buddy Boy start a business. We're now partners. We determine how we split our profit and loss. We calculate the profit and loss on Form 1065. You calculate your profit and loss. It's a pass-through entity. Any profit and loss is allocated on Form K1 to each of the partners, and the individual partners report that profit and loss on their individual tax returns. If you want legal separation between your partnership, you can form an LLC. You can be a multi-member LLC. Okay, so if you're by yourself, you're a sole proprietorship or a single member LLC. If you're in a partnership, you're with somebody else, and you can form an LLC as well. For an S corporation, you can be by yourself, or you can have, I believe, up to 100 shareholders. You would consider forming an S corporation if you want to potentially reduce your self-employment tax, which is Social Security and Medicare. But it becomes with a lot of filing and tracking requirements. It's a lot more work, okay? So it's only really beneficial once you start making a ton of money, a ton of profit. I'm not there yet, but at some point, I will be an S corporation. And it's actually better for me because I don't have to pay somebody to file my 1120S. But if you want me to file your taxes, I'm going to charge you. Oh, yeah, baby, I'm going to charge you so good. Okay? If you want to be taxed as an S corporation, it's an election with the IRS. So you file Form 2553 with the IRS. There's certain filing requirements. And if you take money out of the business, you got to make sure you pay yourself reasonable compensation, which is the value of the services you provide to the corporation. Because you as the owner are also an employee of the corporation. So you got to pay yourself a salary, which includes payroll taxes. So it's a lot more work. But you can be by yourself. You can be what do they call it? A single member LLC that is taxed as an S corporation. Or you could have multiple owners of the business. Partnerships are a little bit more flexible when it comes to like allocating profit and loss. S corporations are not that much. Most small businesses that are making a lot of profits or doing pretty well, from what I've seen, they seem to mostly be S corporations, okay? Because you can potentially save on payroll taxes, and it's a pass-through entity. All the profit and loss is reported on your individual tax form. And finally, a C corporation, which is taxed at the corporate level. C corporations are taxed at the corporate level. Any profit is taxed at the flat 21% by the feds and whatever your state taxes. Then if you want to get money out of the corporation, you got to pay yourself, C corporation, you got to pay yourself a dividend. And that dividend is also subject to taxes. As an officer, you can also pay yourself salary, and that's subject to payroll taxes. Okay, so it's double taxed. Okay, no matter what, if you want to get money out of the business, you got to pay double. You got to pay a bunch of taxes. So, in a lot of circumstances, it's probably not the best deal. So that's kind of the difference there. I do file taxes. See the pinned comment below. I do sponsored videos. I do whatever. But this coming up tax season, I will take anybody that's a sole proprietorship, an LLC, a partnership that's an LLC, or not an LLC. I'll take any S corporation. I'll take any C corporations. I don't do trusts, but I will gladly file your taxes for 2024, okay? Hopefully you learned something educational. Hopefully it was entertaining. And give me all your money and have a wonderful day. Cheers!